Hi, everyone. Thank you for coming to our panel. I think it might be good for us to maybe start with a little bit of self-introduction, what your firm does, and how your firm is involved in tokenization.
Okay, I'll start. Meltem Demirors, my firm is called Crucible Capital. I've been in crypto 10 years, DCG coin shares, now building this firm Crucible. Our focus is the energy to compute value chain. Energy, compute, crypto belong together. I think these are the three biggest trillion-dollar investment themes of the next decade, so that's what we're focused on. I'm going to be controversial and say tokenization, RWAs, unsure how relevant they are. I'm very excited about perpification and synthetics, synthetic derivatives. So yeah, that's us.
Ben Forman, a founder of ParaFi. We're a multi-strategy investment firm focused on the blockchain ecosystem. We have venture and hedge fund strategies focused on different liquidity spectrums and different risk returns in the ecosystem. I spent 10 years in traditional finance at KKR and TPG before starting ParaFi in 2017. And our focus is really on this intersection of traditional finance and blockchain. So things like DeFi, stablecoins, tokenization are all very core to what we do.
Hi, everyone. I'm Alpen. I'm one of the lead partners at Borderless Capital. We typically would put most of our investments in the cryptocurrency blockchain sector. We're big proponents of this category of tokenization. I think RWAs is a little bit of a amorphous category, but I think that we've been very bullish about this concept since inception, so almost I think 7 years when we first invested in Securitize. And I think that at this point, we're I think getting to see some significant interest and traction in the space. Beyond venture investment, we also do liquid investments, and excited to talk about that.
Yeah, so I think tokenization is a pretty well-known concept in crypto, but in mainstream finance, it's still sort of thought of as a small niche. Can you maybe break down, what are some of the opportunities in tokenization today?
Sure. Yeah, I could just start off. So I think the way we think about tokenization is it's kind of almost like a gut renovation of some of the key market infrastructure. One of the biggest problems that we've seen, even though this is one of the earlier themes that a lot of institutions and VCs were interested in almost 6-7 years ago, is that coordinating across so many different actors is a major challenge. So there hasn't been clear standards and formats for people to actually interact, such diverse set of actors. And that has taken quite a bit of time to play out. I think that we're starting to see that around certain assets, for example, stablecoins. And I think there's a lot of reasons for why that is. One of which is we have such volatile interest rate environments. We have exogenous factors in the market related to policymaking where we didn't have any clear rules or regulations around these asset classes. Now we're getting to see some more clarity and interest in that. And I think that we're now getting to a point where tokenization has like a technical set of standards, and now we're increasingly seeing an intersection in terms of a regulatory set of standards. And I think that that's really important for this space.
I'll break it down really simply. So I started my career as a trader. I traded commodities. Today, when you trade different assets, you have different screens, right? So if I trade commodities, I'm trading on like ICE. If I'm trading equities, I have a different screen for that. If I trade crypto, I have a different screen. To me, it's been really simple when it comes to investing. My vision, my dream, I want to trade everything on one screen, right? And I want to be able to take that trade life cycle. So when you're trading, right, you have your trade execution. Then once you execute a trade, you can margin. You can use assets you have as collateral to back the trade and hold the position. Today, collateral is very illiquid, especially in crypto, but you need collateral on all of these different venues. So I think what's really cool and really exciting is actually fundamental innovation, market microstructure, as Alpen said. But the dream here isn't like tokenizing things, and I think people get carried away with this idea that somehow if we make something into a token, then it changes distribution. Forget about that, focus on market microstructure and the ability to cross-margin trade on one screen. That, to me, is the really exciting part, is all of a sudden I can take one asset. Let's say I have exposure to an Ares credit fund. If it's tokenized and on-chain, I can use that position as collateral against another position, right? Because what I care about as a trader is my ROCE, is my ability to generate returns, and I want as much leverage as possible. So to me, tokenization is just another way of saying, let's amp up the leverage. That's how capital markets work. So I think it's really important in crypto. A lot of times when we talk about tokenizations, like we want to democratize access. Retail should not be buying most of these products. It's not about democratizing shit. This is about increasing leverage and liquidity in the system through this innovation in market microstructure. So that's my fundamental premise. That's always sort of been the inspiration. And I just think a lot of the narrative around tokenization is nonsensical because we're creating even more screens, right? I'm going to trade tokenized equity on this platform. I'm going to trade tokenized real estate here. I'm going to one screen. We need everything on one screen, and we need to be able to get leverage, more leverage out of existing assets that are sort of trapped capital. That's what's exciting to me. I think there's a lot happening in that space, but also highly skeptical of a lot of what's happening in sort of the broader tokenization space because it doesn't make sense. I think it's important to talk about that as well. And I want to disagree with you guys. We all know each other. We agree on a lot of things. So I think it's fun to talk about maybe the things we disagree on.
Yeah, so I think at its core, you can describe tokenization in one word, which is formatting. You're effectively taking an asset that may exist in a legal agreement or may be held with DTCC, and you're putting it in the file format of a token. And formatting really matters for assets because it makes them easier to move, it makes them interoperable, and in the case of blockchains, this allows you to have atomic settlement, so you eliminate all kind of the back office, legal, compliance, operational costs that banks engage in, and you can hold assets sovereignly yourself if you choose to. You don't have to hold them through brokerages or custodians or intermediaries. And then on top of that, you can actually program in logic directly into these assets. Instead of having kind of dumb contracts like legal agreements, you can have smart contracts and embed if-then statements so these assets can actually move and perform logic tied to the real world on chain. And so, look, I think at the end of the day, what have we built, right, in this ecosystem? We built amazing pipes to move assets around. That's what DeFi is. But DeFi today, the water moving through those pipes are like, governance tokens or ETH. They're not really relevant to, traditional finance. I think the opportunity set is to take the $600 trillion of assets, stocks, bonds, currencies, and commodities, and move them into these next generation pipes and benefit from all these advantages. And to the earlier point, people have been talking about tokenization forever. Like back in 2017, people were saying, hey, we should tokenize this apartment building in Queens and make it more liquid. And I agree with Meltem, like, just because you tokenize something does not make it more liquid. You still need buyers or sellers. But what's different today is I think you have two things that you've never had in the past. One, you have significant institutional interest in this theme. So you have organizations like BlackRock that are fully behind tokenization. The second thing that you have is a much more clear regulatory environment, and that's just changed. And I think those two things have never existed in the evolution of this asset class up until today, and I think that's why that's the why now for tokenization.
Yeah, and speaking of BlackRock, their BUIDL money market fund on-chain recently surpassed $1 billion in assets under management, and that has really sort of illustrated this case for tokenized treasuries, tokenized money market funds. I'm curious, like, what do you think of sort of the sector-specific opportunities within tokenization? We've seen more private equity firms putting their credit funds on-chain.
Can we just double click maybe on stable coins and these treasury/money market funds? So if we just run the numbers, okay, there's $97 billion of treasuries backing Tether, okay? Cantor probably gets paid 20 basis points on that. So Cantor's probably clipping $200 million a year in fees just to custody money market funds for Tether. Circle, $50 billion, so same math, that's about $100 million in fees. So $300 million in fees going to banks just to hold money market funds so we can tokenize them. If we look at BUIDL, right, $1 billion, assume 20 bips to BlackRock. So I think if you're TradFi, obviously you love tokenization because crypto people are paying you 20 bips to hold money market funds. That's a great business. I would be in that business all day, every day. You're literally just printing money. My question is, what I think is interesting is how do we reverse the flows? So instead of taking money and liquidity out of crypto and parking it in managed accounts at TradFi institutions, how do we enable crypto institutions to benefit from flows going the other direction? And that's why I think this whole category of infrastructure finance, private credits, and these other categories where there's actually yield, like a coupon attached to these assets, starts to become more interesting, because instead of just having someone capturing the net interest margin and banks getting paid massive fees to enable this interoperability you're talking about, right? Because there's a fundamental incompatibility between some of these assets and blockchains. So these institutions on the back end, really what they're doing is they're enabling the interoperability, right, by providing that one-to-one attestation, but you're still dependent on a SIFI, a systemically important financial institution. So I think there's still some fundamental work that needs to be done to think about how instead of taking liquidity and money out of crypto, giving it to financial institutions to allow us to mint stable coins, but the money is at the financial institution. It's not on chain. You get a coupon that's an IOU. The question I'm really excited about is how do we reverse the flows and how do we find ways to do this without just taking a ton of liquidity, billions of dollars of liquidity out of crypto and putting it back into the banking system? Because that feels a little bit counterproductive to me. I don't know if you guys.
Yeah, I mean, I think the main issue here again is like around, you know, if we think about tokenization and blockchains as being standards and formats, I mean, nobody is going to adopt them at scale until there's like some kind of, from my perspective, an exogenous catalyst. And I think that that's what we've seen. There's no real momentum shift to trust an entirely new set of standards and set of institutions to move money on chain in a real, at scale and reliably and securely until more recently. And it's only really happened with, you know, stable coins, with dollars that are custodied somewhere else, where you're basically having like a synthetic or some kind of representation on chain. For this to all happen more natively, I mean, I think it takes time, obviously, but I think that's where we're going, right? Where once you trust this format and this standard and this infrastructure and the stack, then it enables you to start issuing natively different kinds of assets. So when we backed Securitize, honestly, it's been 7 years of hoping and watching, you know, the builders, you know, in particular Carlos, really making the case over and over and over again. It was not easy, right? And what we're seeing with Wormhole is taking these opportunities and looking at, you know, the other side of it, which is you can build a platform, and now, as a VC, you see, you know, a plethora of these platforms and L1s and different kinds of structures there. There's a bit of oversupply on the infrastructure side. Then the question is, how do you make sure the liquidity is not all fragmented, as you were saying, right? Which is the biggest problem that we end up seeing as VCs in this particular industry is what I consider the underside of rapid innovation in crypto, which is just heavy, heavy fragmentation across the board. A lot of redundancy. So for us, bets like Wormhole are bets that's going to end, right? We're not going to end up wanting to see the same exact applications on every single chain. We want to see more aggregation and interoperability. And I think the convergence of those things, as represented in some of our portfolio companies, which we're really proud of and excited about, we're starting to see that shift over. So while I agree that, you know, tokenization or the concept of RWA is a bit amorphous and kind of ambiguous as to what is actually going to get traction there, I think that if we think about it in terms of standards, in terms of new market infrastructure, that's where we're starting to see it make sense, I guess, after like 7 years.
Yeah, I think like the other interesting framing that like I look at this from is there are like the fat tail of assets like dollars and treasuries, and like that's where a lot of energy is going. But there's also the really long tail of more esoteric assets that are too small in size for Wall Street to support, but have real kind of like interest and demand. So one example is You're seeing a lot in like the tokenized collectible space. We have a company in our portfolio that's tokenizing Pokemon cards, and it's doing about $500 million of GMV annualized and 40 million of EBITDA. People sending Pokemon cards, they're vaulted in Salt Lake City. They can auction them on chain. They can exchange them easily. The cards are graded. They don't want to custody them themselves, but they want to kind of effectively outsource that and hold them as collectibles, as an asset class. They can borrow against these cards. So the idea is you can take assets that don't have the same prime services as stocks, bonds, like the very fat tail of the asset curve, but get benefits, get the benefits of blockchains, which is fast settlement, composability, atomicity in settlement, et cetera. So, but I also agree with you, Meltem, that like most tokenization today are just IOUs. Like if you have a USDC stablecoin, ultimately trust traces back to a bank. Whereas like what the real goal here is to have the blockchain be the canonical ledger of record and to disrupt like what transfer agents or what D2CC does today. But I just think it's going to take time to get there.
Yeah. So how do you go about solving these problems, the fragmentation and the redundancy in the tokenization space?
I mean, I think there's different approaches. Obviously, I think at the protocol level, there's a lot of people working on interoperability. I think interoperability suffers from the exact challenge that Ben just articulated, which is a lot of interoperability solutions still require trust in a group of counterparties who are running validators or managing a multi-sig, right? Typically, like interoperability solutions have been fraught with some of these challenges around centralization. So that's kind of at the protocol level and the network level. I think at the application level, one of the things we're starting to see is, companies typically pursue this land and expand strategy where like maybe your company that's in collectibles starts with Pokemon cards and then it's watches and shoes and who knows what else, and you kind of expand out from there. We're seeing this now. We've seen a lot of platforms focused on renewable financing, infrastructure financing. AI-fi is a whole category. Who here has heard of AI-fi? Okay, thank you for saving me. I felt like an idiot. Okay, great. So AI-fi is this whole idea that you can tokenize and finance like GPUs and other components of data center infrastructure that are sort of the core capital inputs to provisioning compute. I think that's an interesting category where you start with something like GPU financing, and then you expand out from there to financing electrical infrastructure and maybe eventually entire data centers. And a data center has a cash flow, right, that could potentially be a very large business. So I think at the application level, we're seeing kind of this land and expand strategy. I think the question really for me is who is going to win at the end of the day? That's always the question. What protocol is going to win in terms of what is the home of the majority of the assets? I am not a believer in the multi-chain vision. I don't think we're going to have thousands of blockchains. I think there will be 4 or 5 key chains that gather sort of the most liquidity. I think Bitcoin has earned its spot in that, right, as kind of this reserve bank of crypto. I think Ethereum, Solana right now are kind of the other 2 top contenders. We're seeing a ton of activity with RWA's, pardon me, tokenization on top of Solana. There's a couple of contenders emerging, but I think that is the real question, is what core piece of protocol infrastructure is going to be one of those 4 or 5 winners? And then I think the question is, how do you actually facilitate real interoperability in a trust minimized sort of manner amongst those protocols? And then the question is, what crypto native institutions will emerge that will help facilitate some of that? I think there are a couple of really large crypto institutions that should be SIFIs. Like Binance is effectively the systemic institution of the crypto world. So I do think there will be a role for crypto native institutions to play when it comes to interoperability and sort of aggregated liquidity and being that front end. I don't know. That's
yeah, happy to add a comment about that. I think, yeah, so on the question about fragmentation, I think there's the chain fragmentation, and then there's also just the stack fragmentation. It's like, it's logical to see that there are going to be institutions and teams that are going to look to vertically integrate solutions, whether through acquisition or through expanding their product set. Once they get some level of traction, that starts to make sense. We saw, the recent announcement by Securitize on convergence. I think that there's one aspect of it, which is you have players that are going to try to vertically integrate what offering that they are able to put in the market, so that there isn't so much fragmentation. And then obviously the chains, and we believe kind of in this idea that there will be these incentives to create new layers of core, network infrastructure. There's going to be, I think, at some point, a limited demand for the next one and the next one and the next one and the next one, if there isn't a clear value proposition there. And as the economics start to change for those, right? So I think that that's where we view like the general like cross-chain and multi-chain kind of expansion taking place. But we do think that there's going to continue to be different types of runtimes based on different trade-offs that different blockchains make, and that tools and protocols like Wormhole and others will be needed to create messaging across all of them. And then getting to one other point, which is, what is the future of this? Like, what is the point of this? Is it just like reflecting what's already out there in the quote unquote in the real world? I think that another area that's really interesting for us is we're very big into the concept of decentralized physical infrastructure. And the fact that blockchains and tokens create new forms of bootstrapping these networks, governing these networks, incentivizing and providing like monetizable benefits to participants. So whether those are the Heliums of the world or those become like GPU kind of contributors to a GPU network, we think that whole sector has obviously received attention within the crypto community around this excitement around DePIN. But we think as people like kind of move away from the name or the title itself, this concept makes a lot more sense once things become more and more tokenized, when the format and the standards around tokenization start to become more institutionalized or at least more trusted. That infrastructure, providing communications data or GPU data or GPU service or cloud infrastructure, that's variable globally in terms of where it's available, when it's needed, based on time, based on cost. The demand changes rapidly, and having a system that allows you to trade and price that in a more granular way and be able to trade that 24/7, I think is like, there is no comparable platform other than these types of tokenized infrastructure. And I think as more and more of that activity, I would consider that more like real activity that's actually, that people are interacting with on a day-to-day basis. When that moves over, I think all of this infrastructure will become essential.
So there are a lot of different points here. Yeah, look, I think the fragmentation is natural in industries as they evolve. Like when new technologies emerge, like everyone enters quickly, but over time there's consolidation, and you saw this in search engines or cloud computing. And I agree that there are maybe going to be 5 blockchains at the end of the day that account for 90% of all on-chain activity. And then there'll be a longer tail of 10% that are more specialized, that are more permissioned. I think permissioning is a key element that we need more work done on in the space. I think convergence is a good step in that direction. KYC, AML, and knowing your customer, and that KYC point either happening at the chain level or at the application level or at the smart contract level is absolutely critical. In terms of where value accrues, like I'm actually just skeptical that there will be a tremendous number of winners behind tokenization within the blockchain space. I think a lot of the value will accrue outside of crypto native. So you look at like Robinhood on their earnings call a couple weeks ago, the CEO is focused on tokenization, tokenizing private company stocks, having 24/7 trading and settlement, and actually kind of like rebuilding DTCC. I think BlackRock has a similar long-term vision. So I think a lot of the value will accrue outside of crypto native. Similar with what you've seen with AI, a lot of the value is accrued to big tech. So I think the second way to play the kind of the growth of RWAs from an investment perspective is owning the layer ones, because every time an asset moves, a marginal amount of fees get paid to whatever layer one token those real world assets are being moved on. Ultimately, I believe the most valuable layer one blockchain will be the one that has the most tokenized real world assets on top of it and moving through it. So I think those are kind of the two obvious, or they're not obvious, the two views that I have.
While you're working on solving these problems, what is the regulatory landscape looking like for tokenization? How does that factor into your investment decisions?
I would say post Jan 20th, not as much as before. It's open field day. I mean, our president has his own meme coin, so I think it's definitely a very permissive environment. All of the existing lawsuits that the SEC have for a large part been dismissed. So I think it creates a very exciting opportunity space. We see a ton of people coming back to New York, re-onshoring, which I think is great. Obviously, what's really interesting, did you know Tether is the 18th largest holder of US Treasuries? Tether is systemically important to the US government. This should be much nicer to Paolo in Washington, D.C., given how many treasuries he buys, how much he's bidding. So I just think there's this really interesting opportunity emerging. All approaches are kind of on the table, which I think is very exciting. I think the key question is, and I think what you were alluding to, Ben, and what you just said, which I fully agree with, it's really liquidity that matters. I think the big question right now is, what is the future home of capital markets? America is the home of capital markets. I don't know if that's going to change. A lot of people talk about oh, Abu Dhabi, oh, Singapore, Hong Kong. It's still America. And so I think the big question really for most companies is not about regulation anymore. I think it's about where are markets going and what markets matter. And if you're building anything touching quote unquote real world assets or the financial system, I think unfortunately America is the home for that and will be for the foreseeable future. I think that's the more important question to ask, which is why I always sort of question, when people are offshore in other jurisdictions, why? Because this is the largest capital market in the world by a factor of many, many multiples. And I think similarly, it goes back to the point of protocols as well, right? Protocols that are going to win, it's about liquidity aggregation. I don't know how important the regulatory conversation is anymore. And that's an interesting place to be. This is year 10 for me. The only conversation always has been about regulation and sort of policy. And now that we have everything we've ever asked for from a policy perspective, I think that a lot of founders, some are on the front foot, but many are sort of caught on the back foot, especially if compliance has sort of been your competitive edge. I don't know how long that will continue to be an edge, just given all of the changes we're seeing.
Yeah, just to add to that, I think there's regulation, which is what are the rules, and then there's what are our national interests. And I think the paradigm shift in Washington has been, well, stable coins are actually very critical for us to win. Right now, the US dollar is used in 70% of all international commerce. 70% of all transactions are done in dollars. So we have the dollar hegemony in kind of Web 2. Why would we not want the dollar to be the de facto reserve currency of the internet of blockchains? Today it is, not because the US has supported it, but every stable coin that's issued is basically going to buy a US Treasury. So the more stablecoin growth that we see, theoretically, the lower the cost of capital of our government. And we have 10 trillion of debt that we need to refinance at the federal level in the next year. So,
Let's go.
So we should be, the US government should want stablecoin growth. That should be the baseline kind of desire, because I think it's only in our country's best interests.
Yeah, I'll push back a little bit at Meltem. I think regulation obviously has been something that's been hanging over as a kind of excuse to some extent on adoption. People would say, oh, until there's regulatory clarity, we can't really move the needle significantly. So now what's the excuse? I think the reality is most of the world has already created legislation around tokenized securities, tokenized stablecoins. Japan did it back in 2020. with tokenized securities. They had stablecoin related regulation in 2022. You see it in MENA, you see it in the EU. The US was the only one not to really have anything constructive in the space. They just had views on whether something was or was not a security. And obviously a lot of punitive action that was taken over the last few years. I think regulation is a big tailwind for this sector. The main point, though, is that once legislation like the Genius Act and others are moved forward, having institutions like banks issuing stablecoins is going to bring a lot more liquidity into the infrastructure that we're talking about. And I think that regulation up until now was not really moving much of the progress in the industry, primarily because most policymakers never saw this as a priority area, right? So even if it came up, it was like priority number like 15 or 16, if anything. I was involved in the Libra project. We met with many policymakers. And honestly, like even if they showed interest in it, it was just nowhere near as important. And now, because of volatile interest rate markets and the changes that are happening from year to year or quarter to quarter, and the geopolitics of it, as you just mentioned, really have pushed this concept of like we need to deal with this now, is actually, I think, pretty catalytic for us, right? So we haven't necessarily seen it play out fully, but once Genius passes, I think whether it's Robinhood, whether it's private banks issuing these types of assets, I think is going to make a huge difference to the industry. And I think that over time we'll start to see that mature through to the rest of the sector, I think.
Yeah, a lot of food for thought, and we're out of time. Thank you, everyone.